Today we consider why silver really matters, and it may well be something that you haven't necessarily considered. So let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. So we're going to run through a variety of different charts here just to understand why silver truly does matter. Perhaps one of the best places to actually start here is with the interview of Sir James Goldsmith, which was conducted on Charlie Rose back in the early 1990s. So let's take a look.
When GATT, this last round, this is the 8th round of GATT, started 8 or 9 years ago, the negotiations, the Uruguay round. When it started, the world was a completely different place. Since then, you've had 4 billion people who before were set aside, if you like, held away from us by communism, by other ideologies, and they've all of a sudden joined the free market. Fine, that's fine. Secondly, those people have got massive unemployment. They have very fast-growing populations. They work for almost nothing compared to our populations. I mean, you can employ 47 people in Vietnam and the Philippines for 1 American.
But that's what they said about NAFTA, too.
Well, yes, but you're talking about 4 billion people. Right. You're not talking about 80 million people. And quite apart from that, the idea that you can judge the results of NAFTA so far, in my view, is a bit naive, because it's only been a few months. So let's wait in 5 years and see what's happening.
Power that they have, that China, in the new millennium, will be the world's fastest growing economy.
That's great.
And that it'll be a market.
That's wonderful.
And those people will be buying products.
That's wonderful.
From the industrialized world.
And let's benefit from that. And we can work together. But how do you benefit from that without destroying ourselves? You go and you create a corporation in China. And you build a factory in China. And what do you want to sell? Mugs? Sell mugs in China. And you conquer part of the Chinese market by competing there fair and square in China. That's life. That's adding to the activity of China. You're a corporate citizen over there, you're working over there. But if you move a factory from the States and take that to China, not so as to conquer the Chinese market, but so as to re-import the goods into the States, so as to get cheap labor, what are you doing? What you are doing is you are saying to your employees here, you're too expensive, folks. You want money, you want protection, you want unions, you want holidays. Forget it. We can employ 47 people over there who want nothing. So don't confuse two issues. One is going out to participate in their growing economies by building there and conquering part of the market. The other is merely killing off employment in your own country, getting rid of your own labor force, transferring it over there and importing it back, purely so as to increase your profit margins. Now, the average company has about 25% of its costs in labor costs, including the social costs and welfare costs around it. 25%. When you move, you can say 25% of volume, that is. You all of a sudden can save over 20%. So your profits go leaping up, but you're totally destroying not only the number of people who've got jobs, but also their salaries. Now, you realize that salaries in the States, earnings, weekly earnings, hourly earnings, over the last 20 years have already dropped about 19% in real dollars. It's already been a massive decline. And that is why the so-called recovery, which is a recovery of economic indices, hasn't got the feel-good factor, because people's salaries have gone down. They're going to go down much more. It's only beginning. And the reason is very straightforward. When you manufacture something, anything, this table,
right,
you have a value added. The value added is when you take the raw materials and you manufacture a product. Mm-hmm. The value you add is known as value added. And that is shared between capital and labor. And the whole division, the sharing of that, has been the subject of massive debates for generations. How much should go to capital? How much should go to labor? You've had strikes, you've had lockouts, you've had political debates. All of a sudden, by creating a global marketplace for labor, but by creating circumstances where people are making the same product with the same technology and the same capital, and the only variant is cost of labor, you are shattering the way you share the value added. And that means that you are destroying the basis on which we've been able to create an equilibrium and have a stable society.
And so on the face of it, since 2000, it appears as if gold has acted as a very, very thorough store of value, as we can see in this chart, and has actually performed far better than the SPX index as well. However, the big problem that was really alluded to by Sir James Goldsmith is really highlighted in this chart. So this excellent chart, which was put out by Raoul Pal recently, just highlights back in 2001 when China joined the WTO, how ever since the actual amount of gold earned per hour worked has declined quite dramatically. And of course we can also see the end of the gold standard back in 1971, which has also reinforced that key trend downwards in terms of the amount of gold that is actually purchasable per hour worked. But when we actually look at gold against the expansion of the money supply, here we've got the M1 money supply, we can see that gold actually hasn't done a terribly great job of actually increasing its price level against the M1 money supply. And so therefore we can see that over the period 1983 to 2022, that gold actually has not performed brilliantly against the M1 money supply. And its performance against the M2 money supply has also been similarly disappointing. Now, the traditional definition of inflation is the expansion of currency and credit, which gives rise to the consequence of increased price levels. So what we're seeing here is debasement of the money, but gold actually failing to actually maintain its value over this prolonged period of time. And so what about the S&P 500? Well, if we take the SPX and divide that by the M1 money supply, once again we can see that actually it has once again really failed to perform quite as well as we might want in terms of acting as a store of value. However, it's noticeable that over this prolonged time period that its performance has been far better than that of gold, of course. And so when we consider the SPX against the M2 money supply here, we can see that yes, there has been some progress and that the stock market has acted to provide a store of value to some, but many of course felt burned from their experiences back in the dot-com bubble that we can see highlighted in the middle of this chart, and therefore decided to actually take money out of the stock market, having made significant gains and then significant losses after that period. Many, of course, from the baby boomer generation then decided to actually invest in the housing market, and then we had the housing market run up through to 2007, 2008, and that then precipitated the financial crisis that we saw then. And so meanwhile we can see the Fed funds rate here and the personal savings rate, and what we can see overall is that the Fed funds rate is of course trended downwards significantly over this time period, and so has the personal savings rate, certainly through to 2008 and that financial crisis. And while it has recovered slightly in that time period, it's interesting that it has done so while interest rates have remained at record lows. Once again, this is denying people a store of value for their money. And of course, when it comes to looking at the consumer price index over a longer time period, well, we can see just how pronounced the actual debasement of currency has actually been. Meanwhile, it's interesting to note what has also taken place in the housing market, where house prices across many developed nations have soared quite dramatically as credit expansion has been directed to increased mortgage lending. And we can see that being the case here for the median house price in New York in blue, together with the median household income in red. And we can see that household income clearly has not actually kept up with the pace of house price growth in New York or Boston. And this is certainly true of many other developed nations as well. But the consequence of these increased house prices is also noted in increased debt levels that we can see clearly in this chart here from the Fed. And throughout this period, what we can also see is that the share of the total net worth held by the top 1% has continued to rise. And while it has had a little bit of a bumpy ride, we can see the trend is very, very clear to note here, and has risen from around about 23.5% back in 1990 right up to about 31% currently. So the relationship quite clearly is one of increased currency expansion, increased credit expansion, and increased indebtedness of the middle classes, while the 1% continue to benefit. And at the same time, if we consider the impact on real median household incomes in this chart, well, we can see that the impact has been really quite profound from the period 2000 right through to about 2012 or so, when we sort of bottomed out there. And while it has trended upwards since, there's no doubt about it, this is now on the decline once again. And so ultimately, what we've seen over this period is the absence of a true store of value, an absence of being able to actually lock money away and ensure that the value of that money grows over time. And of course, there has been one asset that has done particularly well as the currency base has expanded. So here we can see the Bitcoin chart against the M1 money supply, and we can see the significant growth in the Bitcoin price against the M1 money supply, which also looks very, very similar for the M2 broader money supply picture too. But I completely understand that cryptocurrency truly is not for everyone, and many people, rightfully I think, have suspicions about it, and so decide to actually go for physical, tangible, investable assets. And this is of course where silver has a key role to play. But what we can see in this chart is how poorly silver has actually performed against the M1 money supply and against the M2 money supply in this chart. But what's so interesting to note now, though, is that we now appear to be breaking out against the M2 money supply. And this paints a very, very important picture for those that have decided to actually invest in honest, tangible assets such as silver, because this graphic from the Pew Research Center really highlights the gaps in wealth between upper income and middle and lower income families that are rising, and the share held by the middle income families is falling faster. And we know this is accelerating with what is currently going on right now. And so why does silver really matter? Well, as far as I see it, people have been denied a true store of value. It is the most heavily financialized and manipulated commodity, and is therefore seen by many as a really cheap, valuable commodity whose value is truly distorted from what it should really be. It's also, of course, a tiny physical market size, and with silver prices so low, it means that the actual recycling supply of silver is very, very low. This overall means that there is a very tight supply because industrial demand has been very consistent over long periods of time, and we are likely to see that pick up in the years ahead. So ultimately, silver investors have a low time preference. They're prepared to actually forego big earnings today for the prospect of future gains. But crucially, they also understand money and what constitutes real money, not this printable currency, this infinite currency that we've been sold the idea of. Silver matters for more than just this. It's an opportunity to break an unfair financial system which has completely distorted the direction of wealth throughout the economy. It's an opportunity to truly build back better, something far, far more positive in terms of a more honest monetary and financial system. It's also an opportunity for those that have been stacking for a long time to rectify the opportunity cost of holding metals over that long time period. To me, it's all just a matter of liquidity preference, whether it's tangible physical assets like gold or silver, or whether it's crypto assets. It's all about a different form of money. It's all about a different store of value. And when we finally see this paper market break, that's when we will see these metals perform as the true store of value they really are. And ultimately, why does silver really matter? Well, bankers use inflation to steal your wealth and keep you working for longer. That's ultimately the key reason. And we now truly have an opportunity, unlike any other time in the past, where investment demand, industrial demand all seem to be gathering significant momentum all at the same time. It's that confluence of factors, I believe, that truly could give us the opportunity to actually build a better financial system, a more honest financial system. And yes, you might rightfully say that I'm being over optimistic, but I far rather have an optimistic outlook on things rather than just be pessimistic. So what do you think? Why does silver really matter to you? Let me know in the comments down below. I'd love to hear your thoughts. Thanks so much for watching. Do consider subscribing, and I look forward to seeing you again next time. Bye bye.